Thank you very much, Edward, Kim, George, and Alex, and Marcos, of course, for your presentations. It's cool to sit with the cool kids. And looking into the room, value investing might be lonely, but at least we can be lonely together. Obviously, a lot of ground to cover. We have a little more than half an hour, and just like to dig a little deeper into what has just been said in those presentations. Kim, I'd like to start with you because you beautifully showed how, in eras of inflation and disinflation, how value versus growth does. And you show that, towards the end of a long disinflationary period when interest rates are at rock bottom and so on, growth is doing well. Now, 4 years ago in 2022, we almost had like the perfect lineup, right? We entered an inflationary phase. Interest rates were going up. They were normalizing from these historically rock bottom levels. And people said, okay, this is the revival of value, This is the time when the Mag 7 and so on fade and value comes back. We wrote about it, the regime change is on us. And then this thing called ChatGPT came along, and for the last 3.5, 4 years, we've had another tech boom, regardless of the interest rate environment and so on. So my question to you is, were the last 4 years basically just a blip, basically just the last hooray of the growth era, and is the value era now upon us?
Well, that's exactly what I'm arguing overall. And I had that exact same sentiment. I really thought that we were finally going to have a great value market. It was going to last for quite a period of time. But then we had this huge new growth phase. And like you're saying, we're in like this huge speculative market now because of this last major phase of outperformance, especially when the underlying environment is going the wrong way. So it's almost it's adding on top of the crazy speculation, the fact that we are in this long-term inflationary environment that will keep, make it inevitable that will happen, because all this financing costs, the raising of the underlying cost to these businesses as they take on more and more debt, and then this refinancing goes higher and higher, just makes it that much more difficult for growth companies to deliver in the long run. So I agree with what you said.
Now, I guess most in the room, because the true believers of SpaceX are probably not here, but most in the room will probably agree with most of what has been said. High concentration, high valuation relative to history, and so on. The problem is, we talked about this 2 years ago already. We talked about this 2 years ago, how concentration is high, how valuation is high. Now, of course, you value investors, you can say, we're patient, we can wait. But still, and it's tough. George, how do you, we know, short-term timing issues are a non-starter. But when do we know when it's too much? When do we know when market concentration into the mega caps is too much? When do we know when valuation is too much? Because it could go higher for another 2 years, couldn't it?
Yep. Could, yes. I don't know. That's why we looked at 3- and 5-year returns, because it's definitely more than 2 years. No, we don't know how long. But what I find interesting is that you already notice that money is going into value in spite of that, because there are enough people out there who are saying, I'm getting a little nervous, and I don't need to maybe they don't know or they don't care so much if it's going to turn in a year or two. They'll just say, I need to diversify into value. And because we've become such a small part of the market, it makes a difference. It makes a difference. Value stocks are a small part of the market, so just a little bit of capital going into them is able to move them, and that's why the performance has started to get good in spite of the fact that you're perfectly right, the concentration has been going up and is very high, and everyone's crazy going nuts about AI. So
But-
I guess we don't care so much.
I wouldn't mind adding to that. Like in Canada, we have 35% of our market is in commodities, and commodities do well in inflation. So the Canadian stock market, in 2022, outperformed the US stock market by 8%. Last year, we had a similar level of outperformance. And deep value managers like ourselves were able to beat the US and, beat it over 10 years. So, only the last 2 months, we've had another resurgence of AI enthusiasm and valuation, and took some of that 10-year performance and softened it up. But the seesawing is, starting to work, and in markets that are particularly advantaged by that underlying fundamentals of inflation are showing it.
And I would maybe like to add that exactly, because, we argued that, sorry, George, we like actually to say that, this decade belongs to natural resources and to value stocks. Now, in the case of natural resources, we were already hoping we made the corner actually before, but then COVID came along. And we all know what happened to oil prices, et cetera, et cetera. So it was a similar episode with the renaissance of natural resources that was holding back because of COVID. And we see exactly the same thing happening now with the situation in AI. And in 22, our fund was up 13% when MSCI World was down 12%. Also helped with natural resources, of course. So when I'm asked what is the right timing measure, I always say, I have 3 boys. I've blown a lot of balloons for birthday parties. I don't know at which time this balloon is going to burst, because all the balloons are slightly different. There is a bell shape that tells me the balloon should burst now, but I have no idea.
Yeah. When we look at the market over the past, let's say over the past 3 years, we've had always phases when, it was all about technology. The market got narrower and narrower, and people said, the market is being pulled by just a handful of big tech stocks, and then it broadened again. Then we had like 3, 4, 5 months period when staples were doing well, healthcare were doing well, energy was doing well, and then it narrowed again, and tech was back. And and every time when it got narrower and narrower, people said, this is the end. This is the final phase until, and then the regime change really will be here. Right now, it's only been a week, but it looks like we're going, healthcare is coming back up and so on. George, my question to you, somewhat long-winded, is, maybe this game of narrowing and broadening could go on for quite a while longer, couldn't it?
It could. We don't know. I mean, but I think what you showed, Edward, is very important, that these IPOs, that the high number of IPO signals atop, and we're definitely getting those now. We're getting some crazy IPOs, so maybe this is the straw.
Jörg, I saw that last week, or this week, that Bank of America quant strategists have come out with saying that 70% of their bear market flags are already there. It's, the general thesis of value investment is it pays off over the long run. It's not, this timing issue is, is painful but irrelevant. And my old boss, Jeremy Grantham, value investor, he when asked about timing of value, his metaphor is, imagine going up a high-rise block, standing on the top of a high-rise building in Miami in a hurricane, and throwing a bag of feathers off the roof, which get carried by the wind. He says, as a value investor, you know those feathers are going to hit the ground, because value is like gravity. You just don't know whether they'll fall on the next block or whether they'll be carried all the way to New York. And that timing uncertainty must be one reason why value investing actually has an edge over the long run, because it's that element of pain that keeps the crowd away that must create the investment opportunity.
Talking about the current market environment and bubbles, what we learn from historic bubbles, We know that the last phase is characterized by euphoria. It's, you know, everyone is euphoric. The very last of the skeptics, they capitulate and, you know, throw the towel. Jason Zweig in the Wall Street Journal, I think a couple of weeks ago, he said, you know, we're not in the phase yet where companies are marketing AI-enhanced underwear. I.e., we're not in the complete crazy blow-off euphoric time yet. And my question to you, Edward, is, you know, would you say, how would you characterize the level of euphoria that you see today?
Well, I mean, I'm with Georg that, you know, that you can't pin the timing down exactly on these things, the skeptics tend to be very early, and they tend to. In fact, there's another idea I came across last week, is that that apparently we're psychologically wired that when we think something is absolutely certain, we think it must be now. Now, of course, the growth investors have a misconception of time because they think the future is closer than it actually is. But so are the skeptics, because we think, oh, this can't last, and therefore it must end tomorrow. As I say, the IPOs taking off, this, you know, massive retail engagement in this market, the growing amount of debt, uncertainties with regard to inflation and long-term rates. You know, let's say if this were to end tomorrow or ended last week, everyone would say that, you know, in retrospect, that the writing was on the wall. But, you know, on the other hand, you know, these markets are also like, you know, the bunny boiler in Fatal Attraction. You think they're dead, and, you know, they suddenly come back. So you can't be 100%, you know, sure until after the fact.
You know, yeah, George, just a second. You know, many people I talk to, many investors who I talk to, they say, you know, I don't want to jump out too early, right? It's almost like St. Augustine, Lord, give me chastity, but just not yet, not now.
Yeah, sure.
What do you make of this, George?
Well, of course, that we would all like to know that, but I don't know how to answer the question, as I've said. But what we mustn't forget is these bubbles don't pop. When bubbles pop, it's because we look at the chart retrospectively and we, oh, look, it popped. It went down a lot. But you know, maybe it went down over 3 or 4 years. The railway bubble was deflated over what in your chart? I think it was like 3 years or something like that. Y2K, it took a while for that. That one was fairly fast, but it took a while too.
Japan, about 20 years.
Yeah. The Nifty 50 took about 5 or
No, Nifty 50 was about 2 years.
2 years?
Yeah.
Okay. But so 2 years is still a long time when you're sitting here saying, I want to hear the bell ring, or what's the signal? We don't know.
Yeah.
We just, that's the point. That's why you want to have value in your portfolio, is my opinion, is because you don't know. Exactly because you don't know.
And what I know is that I know a lot of professional investors that have our mindset, but they are wait for the bell ring.
Yes.
They are passive because they cannot risk their career not being there.
Career risk is you know, is a huge factor, especially, you know, if you work for a universal bank. It's a huge factor. You know, 2 years early is you're out of your job. Okay.
I think one of the interesting factors today is that, unlike the prior bubbles, we have passive investing representing 60% of the markets out there, and quite a few of those investors are doing, every Friday payroll comes around, they're out there actively buying the market as it is. And unconsciously, they're all buying AI stocks. And I wonder to what degree this is going to affect how it unwinds ultimately. I mean, it might make it a bigger peak.
Yeah, and I wrote a piece last week about passive and how I think the passive is now, passive inflows are now driving the market higher and contributing to concentration. And unfortunately, those passive inflows, some of them are actually taking away money from active managers. So I think the Investment Company Institute data for March and April this year was something like, for US, about roughly sort of 70 billion taken from active managers, and roughly, I'm saying, about 120 billion coming in through passive. So the market is actually, to some extent, on autopilot. It's not recognized. The index people, I think, are deluded in that they think they refuse to accept that index inflows actually have an effect on market structure and market valuations.
Well
There's a
played.
good paper by Rob Arnott of Research Affiliates came out a month ago, 2 months ago, which questions that. And what he says is that the cap-weighted index have a large cap bias, and as these inflows come in, they support the momentum in the market. And in addition, markets appear to be inelastic to the new inflows, which means that inflows themselves can move prices. So all these arguments are to say that the index investors today, I think, are running enormous risks that they haven't any cognizance of whatsoever.
Now, one thing that makes the, let's say, everything AI even more challenging for investors is the valuation picture. Now, obviously, we know, or we've seen how we have above average margins, above historically high valuations, and so on. And still, let's take NVIDIA, for example, which is the picks and shovel stock probably of the AI boom. PE 12 months forward, 21, or 20 now. Like in the picks and shovel stock in the TMT bubble was Cisco, but that was valued at 95 PE at the peak. Micron Technology, PE 10. Samsung Electronics, PE 6. So, you know, I'm not making the value case for them now, but, you know, how do you deal with valuation, with the valuation picture in this market? And I've seen, maybe you can add some light on that. You have ASML in your fund as one of the top 10 stocks. You know, how do you deal with that?
I just wanted to say our shovel producer is not NVIDIA, it's ASML. Because we think whatever chip maker is going to conquer this fantastic empire of NVIDIA will use for sure this little hole called ASML, which is fantastic. So we really believe that, yes, within technology, we find some spaces and some pockets where you almost have a monopoly situation, and that's why we like ASML. Now, having said that, Ed was showing this nice chart, and there was a previous chart on Enron, so let's not go fully there, but how much of the E of NVIDIA is in this blurred picture of I give you that, you buy me that, I've sponsored that, etc., etc. And so I would be very, very careful with that. So for us, semiconductors are hyper-cyclical. We were checking them in our team, like many others probably as well, but they were too cyclical for us to touch.
But ASML for you is still a value case?
Absolutely, absolutely, because it's a monopoly almost. Of course, they are also challenged, but let's see. I mean, we believe that they have at least a lead of 5-6 years, which is a lot. And NVIDIA, I think, all the other guys with very, very deep pockets are going to conquer NVIDIA, for sure. So I don't need to reread the book of Carlos on strategic logic to say NVIDIA will have a lot of competition coming. When exactly, we don't know. But all these guys will need the machines of ASML, which is fantastic for us.
So just elaborate on this question of earnings and price earnings multiples. The CapEx, the AI CapEx boom is fueling the growth in profitability. I mean, particularly out to the semiconductors, more or less, you know, I'm going to say off the top of my head, 60% of CapEx flows through to revenue for the semiconductors, whose margins have gone up 5-6-fold over the last couple of years. So, you know, the likes of, you know, Micron, I don't think was earning any money 2 years ago. So, and that there is, you know, this adage of the value investors: you don't buy a cyclical company on a single-digit PE. So you can see that there's earning when the capex boom stops for whatever reasoning, and it stopped, in 2001 for the TMT investment. Then revenue and margins come down. The margins today, as I think I said in my talk, difference today is the margins are that much higher. But it doesn't really matter whether the valuation, whether the overvaluation is in the price earnings multiple or in the bloated earnings relative to normalized earnings. And the other thing I'd say is that during most many great bubbles, and we've seen them in recent years, the beneficiary of the bubble will look cheap at the peak of bubble. I think of the value investors going into U.S. home builders in 2005. Like Bill Miller of Legg Mason, they were all, the home builders were on 1.1 times book. They then lost 70% of their book. So the valuation never declined, but you still lost 70% of your money investing in them. And the miners, were trading on what sort of 10 times earnings in 2012, 2013. Again, lost 60 or 70% of their value. So you can, when there's been an investment bubble, the investment finds its way into the balance sheets of these companies, and then when the bubble bursts, those companies turn out to be value traps.
Now, I want to switch topic a bit. Kim, in Canada, you have a beautiful array of, let's say, value sectors. We have energy, we have natural resources, we have gold miners. Some of the largest stocks in your funds are banks, Toronto Dominion, and so on. Let's talk about gold miners for a second. I think Agnico Eagle is one of the large positions in your fund. They've had a hard time in the past few months because of rising energy costs and the gold price, which is somewhat consolidated. Is the current environment a value opportunity, a buying opportunity for gold miners?
Well, we've certainly seen gold come off. Just to put it into context for Canada, I've been investing since '83, and it's the 5th time in my investment career gold has been more than 10% of our stock market. And in the last year, gold became 15% of our stock market when it was at its peak. And yeah, so the gold stocks today are all trading at very reasonable PE multiples, around the 10 level, which is obviously very attractive when the overall market is high. I think that sometimes you have to step back sometimes and take a look at the bigger picture as well. I mean, I think one of the big arguments for gold is the level of indebtedness of the U.S. government and the devaluation, the ultimate devaluation of the U.S. currency. And so you're seeing central bankers around the world. I mean, 20 years ago, they were all selling out of their gold positions, and they've been more recently buying back in because they don't want to hold so many U.S. dollars. I mean, the report when Trump was coming into power, his economic advisor wrote a report saying, we want the U.S. dollar to weaken. And they are actively out there trying to weaken the U.S. dollar. And I think that we have a bit of support for gold here going forward in the future. Now, saying that, we are neutral weight gold. I mean, I have found, as a value manager, Like the rules of value investing were invented in the US, which is the deepest, broadest market in the world. And most value investors in the US will say, I will never own gold. And that's okay when it's not 15% of your benchmark from time to time. So what we did is how we manage gold in a commodity environment, I mean all resources in a commodity environment, is we say we want to be industry group neutral as much as possible, plus or minus 5%. So for big sectors, that's modest. So that's why we're making that bet. We're there, but we're making more of a bet in our individual names. And the interesting thing in resources is the steady eddies are the big caps, and Agnico is one of them. So is Barrick. And we took down our heavy position in Agnico to buy more Barrick, which was coming into focus in the marketplace. So it's about changing the deck chairs, but keeping your overall exposure moderate, so you don't get burned.
Maybe if you allow an add-on on the topic of gold, because I get this question a lot. What's behind the weak gold performance over the past 3-4 months? Why was that?
I think it's a lot to do with the rhetoric in the market. Like the last 2 months in particular, you had this resurgence of enthusiasm for the tech space, and it's sucking air out of everything else. So we've seen, odd behaviors happening in the marketplace overall. And not just in the gold price, but in the belief that inflation is here and present and staying. You have a lot of people wanting to believe that we can go back to being a fabulous growth environment. And it's that part of that whole speculative mania. A lot of doubt about traditional value thinking in the marketplace or the fundamentals of investing. Very speculative. I think I said earlier, and as you have highlighted, this is one of the great speculative manias that will go down in history, I suspect, in the end. And that's not taking away from how AI will change our world dramatically.
Now, we will hear individual stock ideas after the coffee break. But given we have this concentration in tech, this speculative mania around everything AI, usually that leaves other sectors behind. When I look at healthcare as a percentage of the MSCI world, it's at multi-decade lows. Staples, nobody wants to hear about them. George, where do you find the most exciting value opportunities today?
Well, we're heavily concentrated in Europe, so that's where we found most of the things recently in the last couple of years, because we all knew that Europe was a lost cause economically. Never mind that we have some very good companies.
Such as?
Well, we'll be presenting Wienerberger. They made bricks. I'm like, what could be more boring than bricks and tiles? But
we'll hear about them.
It's an excellent company that went through some very hard times, learned a lot from it, and now has managed the current downturn very well. And on the assumption that even Europeans will build more houses at some point, and that we won't have Wohnungsnot, so this lack of housing forever, it's a great place to be. And in the meantime, they generate cash, they're doing fine. So it's one of those places where you can afford to wait. So those are the kinds of things we've been doing. Mostly Europe so far.
Alex, you've been, over the years, you've been copper bulls. And copper is one of the commodities that has also taken an AI boost, because everyone now realizes, okay, we'll need a lot of copper for all the energy needs and basically all the capex build out there. If I understood, I think you correctly in your intro, you said you were taking your copper exposure down and increasing your energy exposure. Can you maybe elaborate a bit?
Absolutely. Well noted. I actually said that we decided on 13th of February, because of valuation of copper being pretty demanding, to cut in our natural resources fund our copper exposure by 20% and increased oil and salmon on the other hand. So why? I mean, when you have actually over the weekend, UBS published copper will go higher for longer. And usually if the large banks are getting there, if you get now today on Bloomberg a standard chart showing the supply gap visible for everybody, it's in the price. 6, 7 years ago, we had to dig these things out with our good friend Alberto Lavandera, who has been 7 years in Congo for Glencore, and et cetera, et cetera. So it was not as visible as everybody. Copper is needed for everything. So that is then in the price, and then if Antofagasta trades at a P of 30, of course you should not buy it at a P of 4 when everybody is investing like crazy in copper. It's not yet the case, but let's assume we have an energy crisis and we are stepping maybe this direction. The cyclical stocks will be hammered, and we are more than happy to come back in copper because we still believe the long-term story.
Now, in coming back to, I think it was the last sentence of your presentation, Edward, you said, this time may be different. If I phrase it like this, there's been this long time adage, the 4 most dangerous words in investing are this time is different, right? And lately I've heard the adage, the 13 most dangerous words in investing are the most dangerous words in investing are this time is different. i.e., my question to you is, what would make you say, I was wrong, this time actually was different?
What would make me say in retrospect?
Yes.
Well, obviously, US large cap growth outperforms value for the next 10 years, and contra to the, I'm not, Alex showing the GMO 7-year forecast for S&P at minus 3.5% a year, or whatever. I'm not putting in a forecast, a round number forecast, but I agree with Alex's point. Is you can rationally expect nothing from investing in the broad US market over the next 10 years, and that you will get decent positive returns and massive outperformance from small cap value, parts of emerging, so forth, even parts of Europe, and therefore, and there will be a bust. And when you're living through an event, all you have is a historical guide. But what I find is that the historical guides are actually reasonably good. So, as I said, wrote this history of financial speculation in the 1990s, which made it absolutely clear to the readers that we were living through a great speculative bubble. And within a year, that great bubble became, unwound. And then in the next period that followed, I wrote a report and endless pieces about the credit boom and the vulnerabilities, and that blew up with the Lehman bust. Again, there was nothing from a historical perspective. These were all very obvious signs. And all I'm saying is today, I see very, very obvious signs. The flags are there, and the red flags are there, and they're bigger than ever. Now, it's only the past. We're not historicists. We don't believe that the past determines where you get. But that's all. That's really all we have, as far as I'm concerned.
Yeah, I'm going to just to amplify that. Your evidence for this time is different was that NVIDIA is trading at only 21 times, but Cisco is trading at whatever, 90 times or something like that. That presumes that NVIDIA will earn excessive margins for the next 21 years at least, right? 21 times earnings. And their margins, as Edward has already said, and I think Alex said too, their margins are 4 or 5 times what they ought to be for a normal chip company if it earns a normal return on capital. So you have to assume that within 3 or 4 years, they'll be earning a normalized return on capital on their chips because they'll have competition. the market will drive that down. And so then the PE on a normalized basis goes from 21 to 80 or 90. And so we are back at Cisco, and in a sense we do have evidence that people are going crazy right now, because if you really think that NVIDIA is going to earn this kind of margins forever, well, I think you're nuts, frankly. That's just not how it's ever worked in the past. So from my point of view, I think we do have the evidence that people are euphoric, and you can even, it's more than just impressionistic evidence. You can actually do the math and figure it out.
We unfortunately have to come to a close, but I'd like to hear from you. I know this is not fair for value investors to ask value investors, but you have to. If you are forced to buy SpaceX, Anthropic, or OpenAI, the big three IPOs, and I agree with you, Edward, you know, well, let's see about OpenAI if they make it, but you are forced at gunpoint to buy one of them. Which one would it be? Edward?
I think it'd have to be Anthropic, just because OpenAI is, you know, a Ponzi scheme, and SpaceX is, well, it's a sort of, you know, bullshit enterprise.
Kim?
I want to take the bullet, just because that SpaceX IPO, the fantasy land embedded in that. And if you read his biography, I mean, he buries all his problems. This man has had many failures in his career. Why is this one going to succeed? I'm sorry. And I will say the same for all of them.
I'll buy SpaceX because it comes first, and it's more likely that it'll still go up. But you didn't say I couldn't sell it right away, so I'd flip it.
And my
Alex?
answer is, I will check what the share price will be, and I just buy the lowest share price, because I'm not going to lose a lot of money. And maybe a last word, I mean, on the Compass, I mean, I had the chance in 96, 97 to meet Andre Costolani. And I was relatively young then, and he told me at the very end, Mr. Rauchenstein, you just have to keep the memory. And if you remember that you have seen similar things already once before, you're much, much better than the crowd out there.
Yep. With that, please join me in thanking Edward Chancellor, Kim Shannon, Georg von Wies, and Alex Rauchenstein. Thank you very much.
Thanks a lot.
Thank you.